Hi everyone, welcome to tonight's peer connection on RDSP and investing. Whoops. I would like to begin by acknowledging that we live and work on the traditional territories of many Indigenous nations across Turtle Island. While we meet today on a virtual platform, we must recognize the importance of the land and our treaty agreements. We acknowledge the ancestral and unceded territories of all Inuit, Métis, and First Nations peoples. As our spinal cord injury community encompasses many geographies, we ask that everyone take a few moments of their day to find out which unceded or treaty territories you may live and work on. You can use the link www.native-land.ca to learn more. And thank you, Lubna, for putting that in the chat. So I'd like to welcome you all to tonight's peer connection. The peer program here, so on the screen you see myself, Sherry, and Charlie. We're the three Toronto peer program coordinators. And the peer program works to connect clients with a new spinal cord injury with those that have lived experience of an SCI. So all of us on the peer program team are individuals with a spinal cord injury. I acquired mine 17 years ago from transverse myelitis at the T1 level. And I will now pass it on to Charlie to introduce himself.
Thank you, Jaspreet.
Thank you.
Boy, I feel old because I think I did some math and I'm coming up. I think this December is going to be the big 40 years after my hockey accident. So mine's a C5, C6 from hockey when I was 21. And I'm one of the coordinators with Sherry and Jaspreet as well. Don't give advice, just been there, done that, got the t-shirt. You can offer some hope, some encouragement. And all three of us are here to answer questions about anything: recreation, sports, travel, leisure, bowel, bladder, skin, relationships, and RDSPs. I have one, so yeah. And Sherry is our newest member of the team.
Hi everyone, my name is Sherry. I'm the newest addition of our Toronto Peers Program Coordinator team. I acquired my own SCI about nine years ago, March, and have a T5 to T7 incomplete and spinal cord injury. Now I'm using a manual wheelchair. Yes, also I graduated from university after my injury. I went done many things after that. So now I'm here. This is my first month with SCI. Thank you very much, and we'll keep in touch.
Thanks, Sherry. Yeah, so if you would like to connect with any of us peer program coordinators, you can always reach out to us. You can, or if you're not in Toronto, you can always connect with one of our other coordinators in a different region. Before we begin the presentation, just a bit of housekeeping. So you'll see that the presentation is being recorded. You can change your name as it appears on your screen. Should you not wish for your full name to appear, simply edit it as you wish. If you need assistance with that, please reach out using the chat function. After the presentation, we will have a Q&A opportunity. Any questions you have can be submitted using the chat function. Please click on the raise hand icon if the chat function is not accessible to you, and we will unmute you and you could ask your question. Our presentation today is on RDSP and investing. It's the final peer connection in the Dollars and Cents Managing Your Financial Future series. First, we will hear from our presenter, Steve Badali, and then our peer mentor, John Thurston, who will share his lived experience with RDSPs. So Steve is a senior wealth advisor for Meridian Credit Union in Whitby and Curtis, is a certified financial planner, and has over 20 years financial industry experience. He is a dad to 2 daughters and possibly his most important job. Steve?
Thank you, Jaspreet, and thank you to the entire peer coordinator program and the SCIO for having me today. I'm hoping that I can share some good information for all of you about RDSPs. The presentation I have today, it's not overly in depth. It's a very basic look at RDSPs, and I hope that it offers some value to you. Now, I know some of you probably have a bit more experience with this than others, but this is just a basic overview of what RDSPs are, how they work, who qualifies, and basically a rundown from A to Z. Now, Jaspreet did say that we're going to try and hold off questions till the end, which obviously would be best, but sometimes questions will come up that are relevant to the slides or what I'm talking about. So please feel free to ask your questions as they come to you, because I don't want to miss anything. Now, full disclosure, I don't personally manage a lot of RDSPs, and I think one of the main reasons for that is pretty simple. Only 28% of eligible people actually hold an RDSP. And that is a surprising fact to many people, that if you think about it the other way, 72% of people that are eligible actually don't have one of these. So I'm hoping by the end of today, if you don't have one, maybe this will give you the information you need and the desire to possibly explore this for yourself. So let's start from the top. And what is an RDSP? An RDSP was a registered savings plan designed to meet the needs of disabled families and individuals. It is a Canada-wide program, and it was actually it was introduced in 2008. So this is one of the newer programs in terms of registered plans. Pretty much the only newer one would be a tax-free savings account. So in terms of longevity, this is a relatively new program, and I think that may contribute to people not knowing as much about it as some of the other plans that are available, not related to the RDSP. It was modeled after the Registered Education Savings Plan. So unlike an RRSP, contributions to this are not tax deductible. They do not impact your taxes for the year. But they do actually give you access to some additional government funding that you can't get in any other program. So if you want to know who qualifies for this program, simply, you must be eligible for the disability tax credit. And this is something I believe Doug went over with you guys a couple of weeks ago. And hopefully after his presentation, you have a better idea of whether you qualify or not. But simply put, you must be eligible for the disability tax credit. You must be a Canadian resident at the time of opening. So you don't have to remain a Canadian resident, but when it's opened, you must be a Canadian resident. You have to have a valid social insurance number. So for parents with younger children that maybe unfortunately have a disability, some people don't immediately get yourself a social insurance number, but to have access to this program, you need to have a valid social insurance number. So that is one key area that you need to have as well. And you must be under the age of 60 to open the plan. Now, there are some restrictions in terms of your age that we'll get into a little later, and some of the benefits cease significantly before age 60, but you must be under the age of 60 when you open the plan. So let's go over some of the rules and regulations associated with what an RDSP is. So there are two parties that are involved in opening an RDSP, the holder and the beneficiary. And sometimes they can be the same person. So the holder is the person who opens the account and contributes to the account. The beneficiary is the person who will benefit from the proceeds of this account. So as I mentioned, sometimes you can be both. Sometimes it is parents being the holder and the beneficiary is a minor child. However, once the child reaches the age of the majority, they can be added as a co-holder. And there are some specific things that we'll talk about shortly that have a big impact on whether the holder or beneficiary are the same person or whether it's parents to a minor child. So that beneficiary is irrevocable. So you cannot change the beneficiary of an RDSP plan once it is open. It must remain the same. So unlike some other plans, this beneficiary is a lifetime sort of situation. So you can only hold one RDSP plan as well. And to that point, there can only be one beneficiary on this plan. As I mentioned, they're modeled similarly to an RESP in the sense that you don't get to have access to tax deductions, but the growth inside is tax deferred. You cannot have a family plan RDSP like you can with an RESP. So it is only one individual at any given time, and you can only hold one RDSP plan. So you can open an RDSP with your financial institution, and if at some point down the road, perhaps your financial advisor retires or moves to a different company, or perhaps you're just not happy with who's managing your plan, you can change from one plan issuer to another, but only one can be open at a time. So what would happen is you have an RDSP open, you would then go and see your new provider, they would open the plan, and it would be held in a pending status until the proceeds of your former plan are received. At that point, the plan becomes active and your former plan ceases to exist. Now, this is a number that you may think to yourself, well, how the heck am I ever going to do this? But the maximum personal contributions to this plan are $200,000, and that's over the course of your lifetime. And there's a few different ways that you can fund this. One of the ways that a lot of large lump sums are paid is parents who have children who have a disability that qualifies them for this plan. There are certain situations where their RRSPs can be transferred to the child's account, and it's a way of estate planning as well. So by naming the child as the beneficiary to their RRSP plan, you can actually contribute some of that money in a tax deferred way as well. Now, I'm not going to get too deep into that. That's something that you should see a financial advisor about, but it is a way for, I guess, generational passing of funds to take care of your children if they happen to be disabled. So let's talk about some of the benefits. And I think this is one of the areas that I find most important, because the whole point of this is you want to get a benefit out of it. And it is designed to be a long-term savings plan to provide a person with a disability an income stream in the future, or a source of assets in the future. So some of the benefits that are associated with this plan are you can invest the money that is in this plan, and that money is growing on a tax deferred basis. And again, the investment choices are similar to what is available in a registered retirement savings plan. And that's something, again, best discussed with your financial advisor. But there can be significant benefits to this tax deferral, so that the money that you have invested can grow until you're ready to use it without fear of being taxed on this. And it can actually grow significantly greater by deferring the tax to a later period in time. This is arguably what I think one of the best parts of this program is. And there is government assistance available in two separate forms, which we're going to go into more detail shortly. But the government will actually contribute grants and bonds into this plan. And that is money that you don't have to put in yourself. The government will just contribute. And there are restrictions to the money that the government puts in. Again, we'll get to that in a later slide. But I think personally, this is possibly the greatest benefit of the plan itself. That and the fact that you can provide yourself an income stream in the future. And again, that's for another slide. But the point of this is it's a long-term strategy to provide you with money as you age, and a consistent stream of income at some point as well. And the money that you use, it can be used for any expenses. It doesn't have to be specific to your disability or disability related items that you may need. Unlike the RESP, this doesn't have to have a qualification of a school, I guess, enrollment or anything like that. So this truly is to provide you with an income when you need it. And this is something I think everyone is surprised to hear. And again, one of the greatest benefits is you are not actually required to contribute any money yourself in certain circumstances to actually receive some of this government funding. So you may have seen that $200,000 number and stuff about grants and bonds, and you're thinking to yourself, well, I'm on a tight budget. Maybe I can't afford to contribute to this plan myself because I have a lot of other needs. And I just don't think that this is relevant to me. because I don't have money to put in myself. And that's, again, possibly the greatest asset to this plan, is that you don't necessarily need to add any of your own money yourself. So let's talk about savings grants. So this is a pretty wordy slide, and I'll try and break it down for you as best as I can. So this part of the government compensation, you are required to put your own money in. The amount of grants you receive will actually be reduced based on your income. And if you recall, I mentioned income and parents and minor children in the past. So for parents of a minor child, I guess, the income that is used to determine eligibility for this program is based off parental family income. So it is not based on the child's income, and that's where it may not be as beneficial for the child in their younger years. However, as a child reaches the age of majority, it becomes the parental income no longer, and it is the income of the actual child, or at that point, the person at the age of majority. If you're already over the age of majority at the time of opening the plan, it's based on your own income, familial income. And this is where we get to the wordy part. So if your family income is under 98,000, the grant is 300% on the first $500. And to put that simply, for the first $500 you put in, if your income is under 98,000 as a family, you put in 500, the government will put in $1,500 on your behalf. So it's pretty significant. It's 3 to 1. On the next $1,000 that you put in, the government will contribute $2,000. So simply put, if your income is under $98,000 per year, you put in $1,500, and the government will actually add $3,500 extra money to the plan. It does get reduced if your income as a family is over 98,000. And this is why I bring up the parental income versus the minor's income. If your income is over 98,000, you get 100% on the first 1,000. So you put in 1,000, the government will match that 1,000 with 1,000 of their own. So for someone making an average income in Ontario, most people can benefit from that $3,500 in government grants, and unused grants can be carried forward up to 10 years. And the maximum annual grant you can receive is $10,500. So that is 3 years worth of grants combined into one contribution year. Now, if you recall, I mentioned you can open these plans up until the age 60, under the age 60 to 59. But you will not receive any grant money after the age of 49. So that's something to be aware of. And the second, arguably, like I said, one of my personally feeling is the most important part of this plan is the disability savings bonds. And this does not require any contributions of your own to receive this money. However, the income thresholds are lower. And oh, sorry, I forgot to mention, on the disability savings grants, the lifetime maximum is $70,000. So you can receive up to $70,000 in government money for the grant portion. Now, the savings bond portion is limited to $20,000 and it is based again on family income. And if your income is under $32,000 per year, the government will actually contribute $1,000 with none of your own contributions being required. So if you have an income under $32,000 and you don't have one of these plans, you're missing out on $1,000 a year of free money. I don't like to call it free money, but it is essentially money that requires nothing from you other than to open this plan. These grants can be carried back 10 years as well. And you can actually receive up to $11,000 in 1 year from this plan. So 10 previous years plus the year that you're in. So you can receive upwards of $11,000, well, up to $11,000 in 1 year from this program with no contributions of your own. So there's a big opportunity that people I don't believe are as aware of as they should be. And one thing that is very important to note about this income is based on the year of which you're claiming the grant for. So if you're claiming 5 years worth of grants and disability savings bonds, it's based on the income of each year that you're actually requesting it for. So say 5 years ago, you made $55,000. That 5 years ago, you won't qualify for the bond. But if your income went down under the $32,000 threshold at any point in the previous 5 years, those years you would be eligible for that. So again, this can be carried forward for up to 10 years. The last payment is made to the beneficiary in the year that they turn 49. So 2 great programs that the government is offering, and arguably the reason why you should probably have an RDSP if you don't. So this is something that comes up quite a bit, as people are worried about the impact of their social assistance benefits, because if you have a certain amount of assets, you get certain programs clawed back, or if you have too much income from certain sources, again, you can have benefits clawed back. Not the case with an RDSP. So RDSPs are considered fully exempt assets in Ontario. At no point will these impact any of your social assistance programs during the accumulation or income phase. So the money you hold within and the money you draw from this plan do not impact your entitlement to social assistance benefits in Ontario. Other provinces, there are some restrictions, but here in Ontario, which we're talking about, you do not have to worry about that impacting OAS, GST, GIS, or other government benefits. Oh, sorry, I went a little too quick there. And it does not affect ODSP, which I think is something that people are concerned about. So I will say, don't be afraid of this plan because of what it might eliminate you from, because it theoretically should not eliminate you from access to any of these plans. Do we have any questions, by the way, that have come up?
We did have one question, oh, 2 maybe. We had 2. So one is, what happens if the beneficiary passes away? And then the other is, can you back claim the RDSP if you are, say, 51? So I don't know if you want me to, if you want to answer both, or if you want me to repeat one after.
So I believe the answer to the can you back claim it after 51, I don't believe so, but I will have to double check on that. Again, I don't do a ton of these because they're just not enough people take advantage of them, but we will get you an answer for that. And in terms of the death of the beneficiary, we'll get into that a little later in the presentation.
Thanks, Steve.
Yeah, no problem. So putting the funds to use, obviously.
Can I ask a question too?
Yeah.
With the back claims, would you have to be disabled then? Or can you do it even if you weren't disabled then?
That's a good question. And you have to be eligible for the dividend or disability tax credit in the year that you're claiming for. So,
Okay.
and actually Jasper brought something up in our pre-meeting that you have to file your taxes. If you don't file your taxes, you cannot access this program because the government has no idea how much income you're making. But it is only the years that you're eligible for your disability tax credit that you can claim for the grants and bonds. So I hope that answers your question.
Okay, so I can back claim for grants because I already qualified for it. I filed my taxes from last year. I was qualified for it last year. I do have an account with Prime America.
Okay.
Yeah, so I'm new at this. I just turned 46 last month. So what can I do to maximize before I turn 50?
So before you turn 50, you would obviously want to go see your advisor. Number one, that's
Right.
the best way to go. But any year that you were eligible for the disability tax credit, you will be eligible for the RDSP. The plan did not have to be open for you to be eligible. So provided you meet the other criteria, you didn't need to have an RDSP open to back claim. So you will be able to back claim for last year, most likely, not knowing your full circumstances, but you should most likely be able to get last year's benefit for
Okay.
the grants and possibly the bonds. And again, it's going to be related on your income and other stuff. I have my contact information at the end of this and it will be shared out also. So If anyone has specific personal questions or personal requests that they want to go over with me, they can contact me anytime, yourself included. So I will say that I'm available for answers should anyone have specific questions that maybe they don't feel comfortable sharing right now too.
Okay, thank you.
You're welcome. So putting the funds to use. So this is something that you have to be well aware of, and this may be something that impacts you personally, the gentleman who just asked the question. The 10-year rule. So any funds withdrawn within 10 years of receiving grants or bonds are subject to a clawback. So the reason for this is the government doesn't want you using the grant money to then fund further contributions to get additional grants. So you have to have this money essentially not receiving any grants for 10 years before you start to draw an income from it, or you will receive I believe it's a severe penalty of $3 for every dollar you withdraw. So if you withdraw $1,000 from this plan, you would have to have $3,000 of your grants and bonds clawed back. So it's a significant penalty. And again, to go back to the beginning of this presentation, this is meant for a long-term savings plan to provide you with funds and an income after that grant and bond 10-year period has passed. Otherwise, you're going to have to pay back essentially all of your grants and bonds. So that's something that you need to be aware of. You can take lump sums of this, or you can create an income stream. The year you turn 59, you have to convert it to something called a lifetime disability assistance payment plan. And that creates essentially 20 years worth of income, give or take. It's geared off an age of 80. And there's a formula involved, which I already mentioned. I didn't want to get into because it can be relatively confusing, but over the course of your lifetime from 59 to 80, the funds are paid out in equal portions. So it will create an income for you. Now, some or all of these can be taxable. So any money that you contribute yourself will not be taxable when you take it out because you did not get a tax benefit when you put the money in. Only the grants and growth will be taxable as you take it out, and bonds, sorry for that. So that's something that you need to be aware of, is that you will have to pay tax on some of this money, but again, it's not going to impact your entitlement to other government benefits. That's one of the ways that this was put together so that you don't have to do that. Now, redemptions must start at age 60. There's no other way about it. You have to start taking your money out. And the reason why grants and bonds can't be paid after 49 is because if they force you to take the money out at 60, there would be no benefit to having that 10-year time period of grants and bonds because they'd just be clawed back anyway. So it's to prevent you from having your grants and bonds clawed back. But you, for example, if you started putting maximum in at 20 and you managed to get your $70,000 in grants and 20,000 in bonds, you're 40 years old by the time you're done. Theoretically, at age 50, you could start to draw from this plan without having to pay back grants and bonds. And you can actually convert it to that annual payment or steady payment plan at any time. You don't have to wait until you're 60, but you'll be subject to the clawbacks if you haven't had your 10-year rule. And once you start that, you cannot turn it off. So it's like a broken tap. It goes on and you're forced to take the money. So maybe there's a year that you don't want it for some reason. You cannot turn it off. So you can take lump sums out, as I mentioned here as well. And it's just going to be, it's going to be situational for you. I mean, everyone's circumstances are completely different. There may be some similarities, but no one is living your life. And we don't know what you may need or what you may not need. And again, although there's a clawback rule, sometimes you just need the money. So I will say that whenever possible, you want to avoid the clawback because that's really where the big benefit of this program is. And you don't want to give that back. You want it to be there when you get a little older and then you can draw from that. So grants and bonds stop at 49. At 59, you have to convert this to an income stream. And by age 60, redemptions must start. So it basically is structured in a way to try to eliminate you from having to pay the clawback amount, but again, it's not guaranteed. So termination of the RDSP. Someone asked about what happens if you pass away. So 2 events can cause the closure of the plan: death or end of a disability. So disability a lot of times is permanent, so that's a less common scenario, but unfortunately everybody passes away at some point. And if you pass away, the plan will be collapsed. In the event of the end of a disability, it may be collapsed, but it isn't required. So there are some unique circumstances where you may be in a sense of remission, where your disability tax credit eligibility is no longer, but there's a likelihood that it may come back in a certain period of time. So you can keep the plan open, but let's talk more about what happens if you pass away. So if you pass away, the plan must be collapsed, okay? And it is basically payable to your estate based on whatever your will say. And unfortunately, if you pass away within that 10-year time frame of receiving your grants and bonds, your estate will be subject to the repayment obligations like we discussed above. So it's not something anyone really wants to consider, but that is a potential risk if you pass away, that you'll have to repay that. Now, that lifetime income plan that we talked about, there are some, I guess, fine details that can be looked into. And one of the things that can be adjusted for is an expected shortened life expectancy. So if your doctor believes you have less than 5 years to live, you can take out more than the eligible amount. I forgot to mention that lifetime income plan is subject to a maximum amount you can take out per year. If you have a shortened life expectancy of under 5 years, that no longer applies. So you'd have to go see your doctor and they would allow you to accelerate the redemptions. But again, it's always subject to these repayment and clawback obligations, which are overly punitive. So that is basically what I like to call the basics of an RDSP. And there is a lot more to go over in terms of specifics and how it applies to your personal circumstances. So I will say that I hope that you got some value out of this today. Again, not a very long or overly thorough presentation, but I feel like there should be some benefit to everyone to join today. So I hope that there was some benefit for all of you. This is my contact information. I will share it with the peer panelists and make sure that they can share it with you as well. I'm happy to answer questions as I can. If I don't know the answer, which happens, heck, nobody knows everything. I have a great group of individuals that I can reach out to make sure that we get you the right answer, because there's nothing worse than getting the wrong answer. So I just want to thank you all for joining today, paying attention to me ramble for however long it's been. And I guess we will turn it over to John Thurston, who is here to tell us about his personal experience with RDSPs.
There is one question, Steve, is if the beneficiary passes away, is that very hard to change?
So you cannot change the beneficiary.
So if I name my wife as my beneficiary and she predeceases me, then I have a problem.
So the beneficiary of the RDSP technically is yourself.
Oh, okay. Good, thank you.
Thank you. And yes, thank you. John Thurston. So John Thurston is one of our peer mentors. He was born and raised in Dunsford, Ontario, and sustained his spinal cord injury at the T10 level. He is a Paralympic athlete in wheelchair curling and also an athlete with the Team Canada Disabled Water Ski Team. John?
Yeah, thanks, Jaspreet. And thanks, Steve, for that presentation. It was good. I think I caught some things there that I didn't even know. So not that I know a lot, but I did open an RDSP in 2013. It was made aware to me by my financial advisor. Kind of went over the benefit of opening one. So if I'm right, it was a matter of me getting the forms, taking them to my doctor, him signing the forms saying I was eligible for the disability tax credit, and then I was eligible for the RDSP. And I do believe it worked for me. So my injury was in 2008, so I believe I got the savings bond back till 2008. I think I got 5 years, if that's correct. But yeah, so I think it's been a great savings plan for me. Like it's the government grant that you're eligible for every year is quite unique and amazing, and I'm thankful that I was told about it so I can take advantage of it. So for me, it's a long-term savings plan for me. Just when I get close to that 60, that I can have another income source. So it's been a great plan that way.
Thank you, John.
Welcome.
Yeah, Steve put some information in the chat from Canada Revenue Agency, and also Sheila has put something in the chat about the financial health. So through our websites, you feel free to check either one of those out. Any other questions?
I do. I have a question for Steve. Steve, if someone is approaching 49, do you have any advice? And also, once you are 49, do you know how we can continue growing the RDS? Like, what should you do once you are 49? We don't have a guide. We don't come with what to do after you turn 49, right? So
Okay,
yeah.
I'll try and give you the benefits. So one of the great benefits of this, aside from the government contributions, is the tax deferred growth on the investments that you have within it. Now, I don't want to get too involved in what the investments can be, but there can be good growth in terms of the amount of what you've accumulated by the age of 49. And that growth continues to grow tax deferred until you decide to draw an income from it. So that would be, to me, the highlight of why you would want to just basically leave it as is. And it can be a reason for you to want to open one after the age of 49, because again, if you are not using an RRSP, or you don't want to contribute to an RRSP, or maybe you're not in a situation where it financially makes sense, you can contribute to this plan up until you're 59, provided you're not accepting the grants, which you can't over the age of 49. You're not going to be clawed back on that. It's the grants that are clawed back, not the growth. So the tax deferred growth can have a massive benefit, because you're not getting hit with a tax bill on the growth of that pool of capital every year. It doesn't start until you turn 59, when you start to draw an income. And as I said, in the event that you had a disability for a longer period of time when you were younger, Charlie was a great example. I believe you said you were 21. I think that might have been before 2008.
Yeah, I was 1982. Sorry.
Yeah. So, for someone now that's younger and say is 20 years old today, and they had the unfortunate issue of an injury or disability of any sort, you could theoretically accumulate maximum grant by the age of 40. So by age 50, you could start to draw an income from this, especially if you needed the funds for something. So it is going to be very situational, and the true benefit is that you get to have that tax sheltered growth on your money. And if for some reason you topped everything out and you stopped your grants and bonds by age 40, by age 50, you could draw an income from it without any clawback. So there's that circumstance where you would definitely be benefiting from this plan.
So if you're 60 and you start withdrawing income and you're also still working, will this impact your tax brackets?
It is taxable income. So it is taxable income. It just doesn't impact your other government benefits. So it's not going to impact those, but it will impact the tax you pay. So depending on what your current tax rate is, this will be taxed at that tax rate. So that's one thing you got to be aware of. Now, again, not the full amount necessarily is going to be taxable. It's any government contributions and any growth. The money that you've contributed yourself will not be taxable on the way out because you didn't really get a benefit on the way in. So does that help, Lubna?
Yes, it does. Thank you.
Not a
Like
problem.
you'll be taxed on the gains, like a capital gain.
Yeah, like you're taxed on it as income. And the specific income type, I would have to double check because, again, I'm not an expert at everything, not an accountant, that's for sure. But yeah, it looks like Fahim has a hand raised.
Hi, Steve. Thanks for the presentation. From an investment strategy perspective, sorry, could you hear me?
Yeah.
From an investment strategy perspective, is it possible to invest more aggressively with your funds and with the government funds to invest more conservatively? Just to, for example, take your investments and put them into stocks, and the government grants and bonds put them into the GICs, so that if there was a clawback, it would only be on those funds there, but your
So
funds are going faster.
the clawback isn't based on the growth of the grants that you invest within. It's based on the grants you've received at the time.
Right.
So I don't believe the growth of the grants that you have impacts the clawback availability. It's basically, if you have 3,500 in grants, you can have 3,500 clawed back. Whether that 3,500 grew to 4,000 or 5,000 should not impact the amount of clawback. It should be limited to that 3,500 that you received from the government, not the growth on the funds.
Yeah, I understood that part. My question was, if I'm trying to diversify the funds that are in here, conservative and aggressive, should I put the stuff that I'm investing in more aggressive funds versus what the government is providing me into something a bit more conservative?
So from a standpoint of clawback and growth and taxation, it should make no difference how you structure that.
Okay.
It will all be treated the same. Growth is growth as far as the government's concerned. So if it's growth on your own money or growth on the government money, they still look at it the same way.
I see. Okay. Makes sense. Thank
Is
you.
that better?
Yep.
Okay, cool. In terms of aggressive and whatever, that's something that you would want to speak to your personal financial advisor about. If you don't have one, and if anyone doesn't have one, Meridian has 100 offices in Ontario, give or take, and we're happy to help you, whether it's myself or anybody. But if you have further questions, Fahim, I believe it was, please feel free to contact me. I'll try and answer everything specific to your situation.
Okay.
Clara has a question as well.
Hi there. I just wanted to follow up on Charlie's initial question. So if you have yourself as the beneficiary and you die, then where do the funds go?
To your estate.
To the
The
estate?
fund is collapsed and it goes to your estate. So depending on what your estate direction is, that's where these funds would go.
Okay, all right. Thank you.
Yeah, no problem.
Does anybody else have any other questions? Those are good questions.
Yeah, they are.
I have a
Again.
fairly easy one. It's going to be on the other spectrum, Steve. I happen to turn 60. Is someone going to tap me on the shoulder and say, start taking out $10? Or should I be tapping my financial advisor on the shoulder?
If you're a good financial advisor, you should be calling your client.
Okay, good.
But it is required. So it will happen whether you participate in that conversation or not, theoretically. So you you should hopefully your advisor will reach out to you this year, and he or she, sorry, will go over basically what your formula works out to. Again, it's a relatively silly formula, not silly, but it's not simple to explain. It's the amount in your account, and then you take 80, add 3 to it, minus your age. Like, it's a bit of a complicated one. And they will come up with a number, and they'll say, Charlie, based on the amount of assets you have in your plan and your age, this is what you're going to be taking out for this year. And every year, theoretically, it could be a different number depending on what's in the plan. And that will be kind of the starting point for your withdrawals.
Thank you.
And I'll
Anybody
just
else? Other questions?
Is John, is it
Go
okay?
ahead.
to Ask
Yes.
John,
Yes.
was this relatively easy for you?
Yeah. From what I remember, it was a bit ago, 9 years ago, but yeah, super easy. I mean, the financial advisor basically just, I think I don't know, did the doctor submit the forms or I did? I can't remember, but my financial advisor basically took care of it all. And then I just contact my financial advisor once a year kind of thing. If I want to deposit money into it in order to get grants. So it's been relatively easy.
So
I guess one question, Steve, is so the grant that you're eligible for, it's continually like proportionate to how much you have put into your RDSP.
so in terms of like redemptions, is that what you mean?
I mean, your slide had the 10,500 per year, I think was the
Yeah.
maximum grant. Now that changes. Now that goes down the more that you put into the account. Is that right?
So after the first 1,500 that you put in a year, depending on that $98,000 income threshold, you don't get any additional grants for that. But provided you're under 98,000, I think the number was, you will be entitled to that 3,500, regardless of how much is in the plan itself. It will be based on your income for the year of which you're claiming that. So, for example, say 1 year you made $100,000 for whatever reason. That year that you're claiming for, you would only get the 1-for-1 match on the first 1,000. But it is for each year based on the year. So even if you were going back 10 years, and of those 10 years, 2 years or 3 years you made over that threshold, it would be dependent on each year. So, I mean, you'd only get 3 years at a time theoretically, but you can carry back 10 years. So it would be based on the income for the year that you're claiming it for, not the year that you're claiming it in.
Right.
A little confusing because I'm confused.
I get that. I think it's more like this is what I know. I don't know if it's right, but like, because you said the maximum grant you can get is 70,000. Is that correct?
Over your lifetime, yeah.
Yeah. So the closer you get to 70,000, the less your grant will be every year. Is that not correct?
No, it shouldn't be. It
No?
should be based on the 1,500 you put in and the income you
Okay.
have for the year.
Okay.
Unless you're at 68,000 in grants that you've received, then
Yeah, I
theoretically you
see.
only get the
Would just be what
2,000.
I
Yeah.
Okay.
Yeah. And I saw another question pop up.
Yeah, there's a question that says, if I have only recently become disabled and I turn 49, actually they just turned 49 in February, what's the maximum they can dump into a fund and the maximum the government will add?
So it will be based on the amount of time you've qualified for the disability tax credit. So if you've become disabled this year, we'll say, and you're 48 and you turn 49 next year, theoretically only a year, maybe 2.
Yeah, so you do qualify for the disability tax credit right away. Like, I was injured in December I still qualified for the disability tax credit for the entire taxation year. So your injury was in February, I think you said. Turned
Yeah,
49 in February. So
yeah. So, and again, Karen, if you want to kind of message me after the fact, I'll try and give you a more exact answer for your situation. I think that's a very specific one, and I'd like to ask you a couple more questions offline, if that's okay. So that we can get you the right answer, because that's why we're here, is to hopefully give you guys some good answers to questions that you may not even known about. But I hope that everyone that joined today feels like they got some benefit from the presentation today.
I just want to read Steve's numbers out in case you didn't get it from the chat. It's 647-708-0181. So you can contact him directly as well.
Yeah, and then I'll just type my email address in again. And if you could just type SCIO in the subject line so that I know that it's from today, and that way I make sure I'm prepared to give you all the help I can.
Is there any other questions?
Yes,
from any of the
I
person-
did have a question. I did raise my hands, but I don't know if you guys saw it.
I'm
But my
sorry,
question,
go ahead.
my question was, if I turn, like I'm on long-term disability, right? And I turn 60 and I start, I start taking out money, will that affect my long-term disability?
It should not affect anything.
So
From
my
my
long-term,
understanding, it should not affect anything. It's considered a fully exempt asset in Ontario.
oh, okay.
And we can, I mean, Martin, if you want, I can try and get a better answer for you to give you 100%, but it is my understanding as of today,
Yeah,
it should not impact that.
okay.
Okay, so I'm happy to kind of take this offline. We're getting close to our time limit anyway. You just, please, everyone that has questions specific to themselves, I'm happy to do my best to get you the right answer so that you have the confidence to make the right decision.
Okay, thank
I
you.
have a question, like, because I know CRA has accounts and stuff like that. Is there any way we can go and check what our unrealized stocks and, our unrealized grant and bond values are? Is there any way we can check that or no?
I don't know the answer to that.
Okay, thank you so much.
I'm sorry, I don't know. That's
I'm
what
gonna
I don't know.
interrupt with that one. I'm really sorry. I have to go, but I have an answer to that one, kind of. So I started mine, so I was injured really young, and I wasn't sure how far back I could go. So the letter that we receive yearly, I think that has a number on it, and I think you can find that out online. They were really good at answering my questions. So I don't know if they will answer your question the way that you would like it, but they were really good at answering my questions that I was like very impressed. Like they looked at my age, they said you were injured here, this is when it started, this is what we can do for you, this is how it will help. So like that number, which I don't have that number, they were very good at answering questions. So I think if you have like those kinds of questions, that number, the number on that paper, which I think if you Google you'll be able to find. I'm sorry, I don't have the number.
It may even be in that link to the CRA, the Canada
Yeah.
website. It may be in there. So take a look in there. That site that I linked, it has a ton of great information.
I don't want to cut anybody short, so we can always take a few more questions, but I just want to make sure that I thank Steve Badali from